Welcome back to Gold and Roll Radio. Today, gold is moving a little lower as with silver and platinum. Gold's currently trading around $12.76 on Wednesday. We're recording this afternoon. We've been talking about seeing some weakness in the metals for a couple months now, and we're seeing what we want to see. We're approaching the seasonal time for the bottom to occur. If we look at the last few years, we've had bottoms occurring in the metals market in the June-July timeframe, as well as November-December. So this is going to be the season when you want to get into the market and watch metals prices rise as we move forward in the next few years. We have some points to make about gold today that are both fundamental and some technical ideas. So where do you guys want to start?
Well, Robert, we can certainly start at least looking at the gold chart, although we've sort of laid out our game plan for the next couple weeks and just watching it progress. I'll be perfectly honest, I kind of thought we'd see lower gold prices by now. We have seen a little bit of a bounce over the last week back up into the 1280s, but we are, like you said, pushing back into the 1270s. So I'd expect to continue to see that stair step down to the 618 at about 1245, probably coinciding now that we're into May, coinciding by end of May, beginning of June, where we should put in that seasonal bottom.
Yeah, some of this price here today was in response to the Fed announcement, and they decided to leave rates unchanged, and what happened is gold immediately bounced up about half a point from where it was, and then it turned down in a very short period of time, just a matter of minutes. It went from its 1287 peak down to where you're talking about now, about the 1276. So basically down 1% from peak to trough, but that's relatively unchanged, as you can see by the chart here, versus where it started the day. I'm not really sure that gold knows how to respond anymore to the Fed announcements, because if they leave rates unchanged, we did see some 1% volatility in a matter of minutes. If they raise rates, it seems like it goes the opposite direction. That would be strong dollar policy, and yet you see gold climb. When they drop rates, what they're talking about doing later, you see gold actually start to decline. So a little bit of a feel-out process. It was fun to watch today, and let's jump into the silver technical chart because it kind of showed real similar action.
Yeah, silver continues to do exactly what gold does, just on a more aggressive and shorter time frame, down in the 1460s as of this afternoon. But we did come down and kind of hit the first top end as the silver turned around back in like November, December of last year, where silver put in its bottom and began to stair step up. So it wasn't surprising to see a little bit of a bounce there. However, silver should likely continue down further, down maybe into the low 14s or even the high 13s, if gold continues down into the 1240s. So we'll continue to follow silver because that ratio is the name of the game here when it comes to metals investing, and watching that correlation back and forth between the metals provides the opportunity to increase your positions over time based on how those prices relate to and change against each other.
Yeah, speaking of that ratio, the gold divided by silver ratio pushed up into 87. So gold actually, if you look at the chart a little bit zoomed in, gold actually with this decline today hasn't broken this little formation we've formed in the last week, whereas silver has and has moved lower. Moving to platinum, platinum has come down into that previous high range around 875. It's currently about 866, and it's going to see some resistance here. As we said a couple weeks ago, we won't be surprised to see it actually pull back a little bit more, but there are things with platinum that it's too long to even list here for reasons of why you should be buying platinum today. We've been talking about it for weeks. This is a good chance to be looking at a little bit lower platinum price.
Yeah, we're relatively unchanged over the last week. So even though we're down about 2.7% today, as you can tell by the chart, look back a week and, we were recording at similar prices a week ago. So a little bit of volatility, but overall unchanged over the last couple of weeks. And that's still, we're still up about 14% so far in the year in terms of where our low was earlier in the year, whereas palladium, it's down 2.9% today, but 4.3% for the week. So it's declined really since the end of March, in my opinion, kind of, as you'll see the breakdown here, it continues a little bit. I'm not saying that the palladium bubble has popped necessarily, but down almost 16% a few more percent and you're kind of technically in bearish territory.
Sure, and I think all of this does get back to what you brought up a minute ago regarding, especially today, because today, Wednesday, May 1st, we are seeing quite a bit of volatility in all of the markets, and it all does rely on recent Fed announcements. So it really helps lend a modern understanding of what the investment world really does look like today. I mean, we're talking about a mindset on a global scale focused solely on free money. In reality, interest rates staying low in an already multi-decade low interest rate cycle should actually be pretty strong for things like precious metals, you would think. You're talking about a continuing devaluing of a currency, but that's not how people view it nowadays. I mean, it really feels to me like we've gotten to this situation of eat, drink, and be merry, for tomorrow we die. With the way people are relying so heavily on borrowed money to prop up and quote unquote insure the value of their pensions or 401ks or other types of accounts that they absolutely need the equities market to stay up. And I think the Federal Reserve Bank understands that at this point, is that we don't know what type of ugliness we look at if we have another 2008, 2010 market cycle.
It's not just their investment portfolio, though, Miles. It's their real estate, too. I mean, we had a 3.8% jump in pending home sales in March, which was completely unexpected, counter to the long-term trend, and that's all due to a dip in the mortgage rate. So you're right. It's a credit-driven, free money type of market.
Exactly. You mentioned mortgage rates coming down. They've come down, I think, the most regressively in a while. And, you know, Trump's sitting here tweeting and saying out there that the Fed needs to lower interest rates. He wants to drop it a point, you know, and they're holding today, but I think they're under significant pressure to actually reduce interest rates. And this mega trend with interest rates declining for the last 30, 35 years, we saw interest rates start to rise a few years ago in the market. The Fed started to raise interest rates a couple years after, actually, the market rates started to rise. And so we had been in a rising interest rate environment, but I think there's a big point here with interest rates now actually going down. You know, the Fed hasn't dropped their rate today. They've held steady, but there's a lot of pressure for interest rates to go down. What does that mean? Bond prices go up. What does that mean? Gold goes up. The last few moves with the bond market rising, gold has followed. They've been kind of in lockstep, and actually the gold price has done better than the bond price, U.S. government debt. So we're ready for interest rates to go down. We're ready for the bond market to come up a little bit. That mega trend with interest rates has not fulfilled its pressure to continue to rise, and now we're actually probably going to see it decline. So I think the pump is primed with that, as well as a handful of other things with gold to just be in a new cycle up. The other thing I'll mention with gold, central bankers are the biggest buyers of gold today, and
because they know.
I mean, look at when the last time that they were buying this much gold, 1971. What else happened in 1971? All you guys out here listening to us on a regular basis, probably listen to David's commentary on the McAlvany Weekly Commentary each week. You might already know this, but in 1971, President Nixon cut the dollar's tie with gold, meaning a foreign country could not redeem their dollars back to us and get gold. He cut that off in 1971. We became a free-floating currency after that, and what happened in the 70s? Inflation, gold went up from $35 an ounce up to above $800. McAlvany got in the business the next year in 72 because he saw this coming. So that's what we have, is we have central bankers deciding to buy gold, the most that they have since our currency went off of a redeemability of gold.
I want to throw up a chart here that represents this exact statement. Okay, this is the death of the dollar over time. And there was a period of time where 1 ounce of gold was equal to $20. Okay, so we'll throw this chart up here. Look, gold isn't this exciting performance-based investment, right? It is an asset preservation. It's a purchasing power preserver for you and your savings. Look at the decline in the purchasing power of the dollar versus how gold has just held steady. It buys today what it bought 25 years ago. It will buy in 25 years what it buys today. So that's the motivation for it. And Robert, you're totally right. Miles, you alluded to the free money too. You guys, I mean, yeah, debt has to concern you greatly. 22.25 trillion already. And now, there's this deal on the table that's verbal, but between Republicans and Democrats to do a $2 trillion infrastructure spending plan, as if money's no object. It doesn't matter. They're just going to create, and this chart will continue. And honestly, if that doesn't freak out, it should, because you are getting robbed by sitting in cash.
One, it's starting to feel like we've gotten to that point where, I mean, maybe the whole system's changed, right? Maybe money is free and you can just pull it out of anywhere, because for the last, Japan has been on a system of stagflation now for 30 years?
Yeah.
And the United States has been doubling our national debt over the last, since the 1970s. We came off the gold standard.
Big petri dish.
Part of me asks the question, hey, maybe we're wrong. Maybe it really is something that the Federal Reserve does have the Keynesian capabilities to just manage on a day-to-day basis ad infinitum, and you can create something out of nothing. I think history tells a slightly different story. So what ends up happening when it seems like even the faithful have given up on reality and just decided to go the way of the aggressive investor leveraged to the hills? I mean,
Keynesian economy.
Yeah, Keynesian economy. What happens if the faithful, if the true diehard Austrians start leaning Keynesian at some point? Well, I think, the 2004, 5, 6 real estate debacle is a bit of an example of that. I think the equities market crash is an example of that.
Well, you got a modern day example now with Venezuela, how it's a failure, right? So you can't print your way out of trouble. You can still get hyperinflation. And that's the other piece to the gold fundamentals, right, is geopolitics. And, we're watching this thing unravel like a modern day Cuban Missile Crisis. We've got concerns of Russian nukes now having been snuck into Venezuela. We've got Trump saying, Cuba, back off of all military exercises, or we will give you a full and complete embargo. I mean, this is taking us back 50 years, and yet at the same time, you've got May Day all over. You mentioned that it's May 1st. It's May Day, man, the whole world. You got France with the yellow vests, and they're protesting the ruling elite. You've got the black bloc who is protesting capitalism. That too will be moving gold, and that's part of the long-term picture of why its value goes up over time.
Yeah, and you mentioned geopolitics. Speaking of Russia and China, you have China and the U.S. going back and forth. Tired of hearing whether the talks are going to go well or be resolved or whatever. But meanwhile, what is China doing? They're talking with Trump. They're talking with our trade negotiators. But what are they doing? They're buying gold. And what is Russia doing? They're actually eliminating a tax that they've had on gold purchases. It allows their citizens to buy gold in a much more friendly way. So all these trade talks are going on, but watch what they do, not what they say. They're buying gold. People around the world are buying gold. And Americans, I'm sorry, you need to get on that trend. It's going to leave you behind. I think if gold, the price of gold, $12.76 today, if we see a little slippage here from the $12.70 range, we have this $12.40, $12.50 range to be watching. But after it completes this, if we get that, we may not even get that move down into that mid 1200s. But after we get this, if we do, it's going up. I think the next number to watch would be 1320. Once we get above there, 1365. And then after that, it's going up higher.
Oh, yeah. At that point, the sky's the limit. I mean, we're getting into numbers from years ago. We're in that interim pricing between where we've been stuck the last couple years and obviously moving into that second mania phase. So people forget how quickly that can happen, Robert, and I think that's a good point. I mean, 1365 turns into 1600, not in the matter of years, but in the matter of weeks.
That's it for us this week. Thank you for listening. You can follow us on Twitter at ICA Gold. You can like us on Facebook, McAlvany Financial. Our website is McAlvany.com. Give us a call to discuss your portfolio at 800-525-9556. Thanks for listening. Have a great week.